I want to talk more about the markets this morning. I want to welcome our guest, John Mowrey. He's the CIO and Senior Portfolio Manager at NFJ Investment Group. Good morning to you.
Good morning, Andrew.
What have you made of this, I don't know, we'll call it a wild ride, like a week and a half or now 2 weeks. 2 weeks of crazy. It's almost like it didn't happen. We can almost just forget that it happened.
Maybe not, though, because actually since the July 10 data point, the NASDAQ's still underperforming the Russell 2000 value by 1,000 basis points. So time will tell if that marked a pivotal moment. And I think that one of the key, obviously, indicators has been, obviously, the inflation reading coming down. And something that I would posit is that if you look at the spread, Andrew, between the two-year bond yield and the Fed funds rate, and to be clear, the two-year bond yield is set by the market, right. Fed funds rate set by the committee. The two-year bond yield has been below the Fed funds rate for now 18 months. And if you go back and you look at this all the way back to the 70s, this is generally predicted aggressive rate cuts, and that duration matters. And so I think that when you look at the setup, you have a really interesting dynamic in some of the less loved areas of the markets that are more exposed to interest expense on their balance sheets.
Okay, so what is your expectation come September in terms of what the Fed is going to do?
Well, I'll say this. The two-year bond yield is telling the Fed they need to take 140 basis points out. Okay, so if you look at where that yield sits relative to the Fed funds rate, that's 140 basis points. And if you look back historically, they generally have taken the stairs and then had to go and take the elevator on the way down. If you go back to 2000, for example, they raised twice in the first quarter and the second quarter, and then in January of 01, they pulled 50 out. So I think they need to pull out 140, and that's based on what the bond market's saying. How quickly they do it is up to them. And what I would say is that just because you showed up late to the party doesn't mean you get to overstay your welcome. And it seems to me that we're doing that right now. So I'm a little bit nervous about the prospects that things are going to get more challenging for these companies.
Okay, so you talked about the stairs and an elevator. What about an escalator?
What about an escalator?
An escalator.
They took an escalator. They took an escalator on the way.
So for you, does that mean you think 50 basis points comes in September?
I think they should do 50 basis points.
But you think they won't?
I think they probably won't. I think they want to give the opinion that they are moving in a very methodical way. But generally, that's not what happens. There's some data point that comes out, like the inflation or like the unemployment print, that really starts to jolt them. So, again, I think that investors should be thinking about the areas that would be benefiting from less interest expense, and one of those areas is REITs, not very loved. Right. But I'll point to two areas that are actually beating the S&P 500 year to date that not a lot of people realize. Utilities and regional banks, both beating the S&P, which is pretty remarkable considering NVIDIA makes up such a large portion of the S&P and is powering so much of the gain. So you're already seeing the interest rate sensitive plays start working out in the marketplace. I expect this will continue.
So you're coming on our air here with a guy who's talking about a sector that's not yet fully valued with the thing about to happen.
Well,
is there more to come?
I mean, if you look at the valuation dislocation in regional banks, it is material. And something that I'd like to always point out is that what occurred in 2023, okay, with the regional banks, that was a liability crisis, not an asset crisis. An asset crisis is what occurred in 2008. This is very different. As those rates come down, that should be further alleviate that pressure on the balance sheet. And the capitalization of the regional banks is far better than it was in 2007, 2008. So I think those areas have a long way to go, Steve.
And is there a time and a place to be buying commercial office real estate, or is it too early yet on that?
I think commercial office real estate is the hairiest and the hardest to get right. And to be quite candid, I don't think you need to go there. You can look at industrial REITs. Right. Those are very well positioned strategically for a number of reasons. They actually will also benefit from what's going on with the AI chips in terms of robotics, automation, how they're going to work their warehouses. If you remember the scene from Indiana Jones in the last scene of Raiders of the Lost Ark, where they're putting that crate in the warehouse, think of a robotic doing that. So it'll be a very different story for the industrial REITs, I think, going forward. So I like other areas than just the office play.
Why not small caps? Small caps would probably be the number one area to benefit from lower rates.
Correct. And one thing I would point out, if you look at interest expense as a percentage of total debt, okay, for the Russell 2000, that's the highest since 2004. But for the S&P, it's only the highest since 2014.
But I don't hear you saying just go buy the Russell 2000.
Well, no, I would not do that because I think there's a lot of companies that are not profitable or not high quality and you should not own. So I think that within small caps, active management does play a heavy role. And to be quite candid, when you look at that opportunity set, there's a lot of companies that simply are not going to be able to navigate the environment. A lot of them have not been able to push through these costs to the end customer.